What if I told you that a few simple mistakes could cost you millions in your lifetime? You see, most people don't go broke because they're lazy. They go broke because they don't know what they don't know. And here's the scary part. 2025 is going to be brutal for those who aren't financially prepared. The economy is shifting. AI is replacing jobs, and inflation? Well, it's not slowing down anytime soon. But don't worry, if you stick around you'll learn exactly which financial mistakes to avoid so you can stay ahead of the curve. And trust me, number 3 is something even smart people fall for. And before you say, "But I have time, I'm still young," remember, so were the people who are now broke at 40. Alright, let's dive in. Remember when a $20 bill could actually buy you something? It feels like just yesterday when you could walk into a store and come out with a bag full of groceries, or maybe even a new pair of shoes. Those were the days when money seemed to stretch a lot further. But now it feels like that same $20 bill barely gets you a couple of items. Yeah, those days are fading fast. The passage of time has a way of making us nostalgic for the past, but it also brings to light the harsh realities of the present. Inflation is one of those silent forces that creeps up on us, making everything more expensive while our incomes struggle to keep up. The reality is that inflation is silently eroding your money every single year. It's not just a concept you hear about on the news, it's something that affects your daily life. Every dollar you have is losing value bit by bit as prices for goods and services continue to rise. If you're just keeping your savings in a regular bank account earning close to nothing, your purchasing power is shrinking fast. Imagine working hard, saving diligently, only to find out that your money buys less and less each year. It's a frustrating and disheartening experience. Here's the math. If inflation stays at just 4% per year, that means in 10 years, your $10,000 today will only be worth about $6,800 in real value. That's a significant loss, and it's something that many people don't fully grasp until it's too late. That's like losing 1/3 of your money without even spending a dime. It's a sobering thought, isn't it? You might think you're doing everything right by saving, but if you're not accounting for inflation, you're actually losing ground. Think about it, that's a brand new car, a down payment on a house, or years of investing just gone. These are not small losses, they represent significant opportunities and milestones in life that could be slipping through your fingers. And it's only going to get worse. If inflation continues to rise, the impact on your savings and purchasing power will be even more severe. It's a daunting prospect, but it's one that you need to be aware of and prepared for. So, what's the solution? You need to make your money work for you, investing in assets that outpace inflation. This means looking beyond traditional savings accounts and exploring options that have the potential to grow your wealth over time. Think real estate, index funds, even starting your own business. These are avenues that can offer returns that outpace inflation, helping you to not only preserve but also grow your purchasing power. Don't let inflation win. But just investing isn't enough. You need to start early. The earlier you begin, the more time your investments have to grow and compound, giving you a better chance to stay ahead of inflation. And that brings us to mistake number 2. Quick question, if I gave you $1,000 today, would you A. Spend it on something cool right now, maybe a new gadget, a fancy dinner, or a weekend getaway? B. Invest it and let it grow, perhaps in stocks, bonds, or even a retirement account? Most people pick A, and that's the problem. We live in a culture that prioritizes instant gratification over long-term benefits. Every year you wait to invest, you're leaving thousands, no millions, on the table. Time is your most valuable asset when it comes to investing. Why? Because of compound interest, aka the cheat code to wealth. It's the principle where the interest you earn also earns interest, creating a snowball effect. Imagine a snowball rolling down a hill. It starts small, but as it picks up snow, it grows exponentially larger. It starts small, but as it picks up snow, it grows exponentially larger. The same happens with your investments. That's compound interest in action. Your initial investment grows, and the returns on that investment also grow, creating a cycle of increasing wealth. Your money makes money, and then that money makes even more money. It's a beautiful cycle. The earlier you start, the more time your money has to grow. If you invest just $300 per month starting at 20, earning a conservative 10% annually, you'd have over $1.5 million by 60. That's the power of starting early. That's right, you could be a millionaire by simply investing what you probably spend on coffee each month. Small sacrifices today can lead to huge rewards in the future. But if you wait until 30, the story changes dramatically. You'd have less than $600,000. That's a significant difference, all because of a 10-year delay. That's a $900,000 mistake. Imagine what you could do with that money. Buy a house, travel the world, or retire comfortably. Let me repeat that. Almost $1 million gone just because you waited 10 years. The cost of procrastination is enormous. Still think investing is optional? The earlier you start, the better off you'll be. It's not just about the money. It's about securing your future. And speaking of optional, let's talk about something most people think they need, but actually don't. Chapter 3. The Debt Trap. Taking on good debt. Without a plan, good debt builds wealth, that's what they tell you. And sure, investing in a business or real estate can be smart, if you know what you're doing. But what happens when you dive in without a solid plan? The allure of potential profits can blind you to the risks involved. You might think you're making a wise decision, but without proper research and a clear strategy, you could be setting yourself up for financial disaster. But blindly taking on student loans for a useless degree, or financing a luxury car when you're barely making ends meet, that's not wealth building, that's self-sabotage. Imagine the stress of monthly payments piling up, with no clear path to pay them off. It's a heavy burden that can affect your mental health and overall well-being. The pressure to keep up with appearances can lead you down a dangerous path of accumulating more debt just to maintain a certain lifestyle. Quick reality check. The average college grad today has $37,000 in student debt. That's a significant amount of money to owe before even starting your career. And with interest rates, that number can grow quickly, making it even harder to pay off. Many graduates find themselves stuck in a cycle of debt, unable to save for the future or invest in opportunities that could improve their financial situation. The average new car payment? $700 per month. That's a substantial chunk of your income going towards a depreciating asset. While having a reliable car is important, it's crucial to consider whether you can truly afford it. High car payments can limit your ability to save for emergencies, invest in your future, or even enjoy simple pleasures in life. That's money you could be investing, saving for a down payment, or even just enjoying life with. Imagine the freedom of having extra cash each month to put towards your goals. Whether it's building an emergency fund, saving for a dream vacation, or investing in the stock market, having financial flexibility can open up a world of possibilities. If you're not careful, debt can feel like quicksand. You sink deeper every year, thinking you're making progress when really, you're just stuck. The more you struggle, the harder it becomes to break free. It's a vicious cycle that can leave you feeling hopeless and overwhelmed. The key is to recognize the signs early and take proactive steps to manage your debt before it spirals out of control. You're working to pay off yesterday's purchases instead of building a better tomorrow. Every dollar spent on interest and fees is a dollar that could have been invested in your future. It's important to shift your mindset from short-term gratification to long-term financial health. By prioritizing your spending and focusing on paying down high-interest debt, you can start to regain control of your finances. So how do you escape? By making smart money moves early. Educate yourself about personal finance, seek advice from trusted sources, and create a realistic budget that aligns with your goals. It's never too early to start planning for your financial future. The more informed you are, the better equipped you'll be to make decisions that support your long-term success. Invest in yourself, but do it strategically. Buy assets, not liabilities. Focus on investments that have the potential to grow in value over time, such as stocks, real estate, or starting a business. Avoid the temptation to finance luxury items that don't contribute to your financial well-being. By making thoughtful choices, you can build a solid foundation for your future. And most importantly, live below your means. This doesn't mean depriving yourself of all pleasures, but rather being mindful of your spending and prioritizing what's truly important. By living within your means, you can avoid the trap of accumulating unnecessary debt and create a more stable financial future. And speaking of smart moves, remember the journey to financial freedom starts with a single step. Make that step today by evaluating your current financial situation and setting clear, achievable goals. With discipline and determination, you can break free from the debt trap and build a brighter, more secure future. Chapter 4. Don't put all your eggs in one basket. The power of multiple income streams. Relying on one source of income is like balancing on a tightrope without a safety net. One layoff, one emergency, and boom, you're in financial freefall. The wealthiest people? They never depend on just one paycheck. They have multiple income streams: stocks, real estate, online businesses, freelancing. They understand that diversification is key. And in 2025, where AI and automation are disrupting jobs at record speed, having a second, even third source of income isn't just smart, it's necessary. Because here's the deal. If you don't build wealth while you sleep, you'll work until you die. Don't be another statistic. Take control of your financial future. And that brings us to our final, most dangerous mistake. Chapter 5. The Procrastination Pandemic, Why Later Never Comes. The biggest financial mistake isn't bad investments, overspending, or even debt. It's procrastination. We all tell ourselves, I'll start next month, next year when I make more money. But the truth? The longer you wait, the harder it gets. Remember that snowball? The earlier it starts rolling, the bigger it gets. The same goes for your money. The best time to start was 10 years ago. The second best time? Right now. Because every day you wait is money lost, opportunities missed, and trust me, you don't want to be 40, looking back, realizing you could have been rich if only you had started sooner. You don't want to be filled with regret wondering what if. So, here's your wake-up call. Start today, no excuses. Open a Roth IRA, invest in an index fund, start that side hustle you've been thinking about, just take action. Outro, your journey to financial freedom starts now. Now that you know what not to do, the next step is learning how to make your money grow on autopilot. And the secret? Compounding interest. I just made a video on how compound interest can make you a millionaire, even if you start small. It's easier than you think. Click here and learn how to make money work for you instead of working for money your whole life.